Hey guys, Brian's here, and I'm recording this video during the second week of March 2023. What we're looking at is a daily chart of the SPX, which is the S&P 500 index. This is the past few years of trading, so we have dating all the way back to 2018 over here. This is the crash of 2020, and then we have the bear markets of 2022. And we're currently at 2023 right here. Now, if you're new to trading options, you probably are familiar already with buying a call option when you think the prices of the underlying is going to go up, or buying a put option if you think the price of the underlying is going to go down, and profiting on picking the right direction. With this video, I want to introduce you the concept of what can be called selling volatility, and it's just another approach to trading options. One can argue it's how quote-unquote professionals trade options. I'll leave that up to anyone to discuss, as there's many ways to make money in the market. But I tend to be someone that falls under the line of actually selling volatility. And when I first started out trading options, I did not start this way. I believe the first book in which I read on options, or the first chapter in which I read on options, was from Alexander Elder, I believe was the author's name, and it was a new trading for the living. And towards the end of the book was not a book on options, it was just about trading in general, psychology, that type of stuff. And then towards the end of the book, he had a chapter on options, and he was talking about how he doesn't trade options, and he's spoken with options quote-unquote traders. And traders that trade options professionally, they sell options, and he was saying they essentially just sell to people that don't know what they're doing, and they think they're constantly trying to pick a direction. And the statistics and the odds show that they're losing a ton of money, so the people that actually make money are option sellers. And why is that, right? So we're going to take a look at some data behind the VIX here, as we have on this chart. If there's one thing to take note of, if we just take a look at this, let's compare the two. So we have the S&P 500, right, the index. If we take a look at this from the start here back in 2018 and where it is right now, it's higher, right? And we can see, except for this crash right here, which was crazy, this is the pandemic, so let's disregard this, right? This insane panic crash. And we have, this is more so a bear market, you know, it's crazy, whereas this was just, I'm going to label it a flash crash, even though it was not a flash crash, especially the state of the world during this time here. But we have this crash, and we have this V-shaped recovery that occurred. We can see that generally it's gone up. If we come to the VIX, which is the SIBO Markets Volatility Index, it is an index that tracks the quote-unquote implied volatility of the SPX. So to simplify that, it's how big of the expected move is given a certain time frame. I believe it's about 30 days, the implied move for the SPX. Implied move is just saying how big does it think the SPX of a move is it going to make? Is it going to be up 100 to 200 points in the next 30 days, or is it going to be down 100 or 200 points in the next 30 days? And it's constantly changing based on some of the options activity that's happening for the SPX. And don't quote me on that, I might be wrong. I read it a few years ago, and then it just stuck with me in case their definition of change. Every now and then I'll check back on the SIBO website to see if they, updated anything. But to my knowledge, the formula for how this is calculated has not changed, nor is that necessarily relevant. Just know that the SIBO is doing the hard work, and then they're giving us a number right here to let us know how volatile things are. During 2020, we had this crash, and we can see it spiked. It went all the way up to 85, which was ridiculous, which is, insane volatility. That means that, the SPX is expected to make huge moves up or down for the next day, in the day or after, and the day after, within 30 days, and so forth. But as we take a look at this, we can see the VIX is relatively flat. I mean, if we were to just draw a line here across, it's kind of just hovering around, this point. To be, if we were to be anal about it and actually draw a line, we can see that's about 17.5 or so, right? And I'm just loosely plotting these numbers on the chart, as this video is more so about the concept behind what I'm trying to share here. If we were to draw a regressional channel out across this, we can see that the VIX is what's known to be mean reverting, and that's something that we can say is, we can say the VIX is a proxy as a whole for implied volatility across almost all options. Granted, implied volatility will be different. For an individual stock around earnings, there will be IV spikes, IV crushes, those types of things. But for the most part, trying to keep it simple here, this is implied volatility. It's mean reverting. That means when it spikes, it wants to come right back to wherever the mean is. If it drops too low, it wants to come right back to wherever the mean is. And I'm just using a regression channel to plot this out on the chart. And then this would be our mean right here on the regression line. And if we were to jump to the SPX, and do the same thing. So just plot it out from here and then just let the system draw it out for us. Here we have a regression channel, and then we can see this is when the SPX is below the regression channel and wants to get back to the mean, which is this way. We can see that the mean, or the channel itself, is in an uptrend. And as we jump back to the VIX, it's relatively flat. Yes, it is in an uptrend, so volatility has been increasing, but for the most part, it's pretty much gone back to where it was X amount of years ago. And even when it has these insane moves during 2020, it kind of came right back down to the level in which one can argue it's supposed to be. The market trades completely different if it's below 20, or if it's above 30. So above 30, you can almost expect it to come back to be below 30. And if it's below 20, who knows how long it might stay below 20. That might be considered normal. Traders that have been in the market since this has been around will probably have different perspectives on it. For the new age or the new era of traders that came about because of the crash of 2020, will have a different opinion on volatility versus the traders that traded back here. There was not a lot of SPX options activity relative to how much there is here, because we have the 0 DTE Monday through Friday. We have a lot more retail traders. We have a lot more smaller accounts that are trading. It's easier. There's more accessibility to options than there was back here. Anyone that was trading back here knew we had to pay a lot more commissions. We also had to pay commissions on equity stocks as well as options. There was not necessarily, Robinhood was not as popular, it wasn't as big back then, so we had to pay a lot more, and that kind of had a bigger gate, we can say, for newer retail traders. So with those two things, as I'm pointing out, we have implied volatility. Take note of that. It's mean reverting, right? We can see that it almost is hard for the VIX to hold its quote unquote gains. If it increases, it's just a matter of time before it comes back. That concept is something that a lot of option traders know, and implied volatility is very important for option traders. So one thing they know is statistically the VIX is going to come back within a certain range. So there's also some strategies that's, in a sense, trade based on that. If we take a look at some data on the VIX right here, this information that you're seeing is from the quant trading app website. So this is just the data page in which we're looking at, and we're just taking a look at the VIX, and this is for the past 365 days. This is how the candles have, in a sense, traded. We can see only 31% of the time, or we'll round it up, we'll say 32% of the time, the VIX actually closed green, and this is based on the daily candles, whereas 68% of the time it has closed red. It's very red on Wednesdays and Fridays, and then we can see that not very red, it just closes red mostly on Wednesdays and Thursdays over the past 365 days, and we can kind of break this down a little bit more down there, but we don't need to get too nuanced with this. Let's just actually change this now to, this was the past 365 days, but let's just take a look in isolation of the start of 2021. And we have, we'll say the year started on the 3rd here, because that was the start of the trading year. And then let's just jump to the December, and then let's just run this report. And we have similar stats here. So 66.8% of the time it's red, 33.2% of the time it's green. This is just plotting the actual net changes right here. So the green is the days in which the VIX actually closed up, and then the red is the days in which it's closed down. What we can see right here on this graph is every time the VIX has closed outside of a 1 standard deviation move, it's had really, really large net changes right here relative to the red side, so relative to the red days. So in other words, whenever the VIX closes green, it closes really green, which means implied volatility spikes. And that's in a sense what we can see here. We can see these days in which the VIX really just jumps up and just rallies, it has these huge spikes. Something that I like to tell new traders to this is think of the VIX almost as like a child that just throws a tantrum. It likes to cause a fit, but then, you know, you just leave it alone for a little bit and then it just calms down by itself. Like, it acts crazy, it makes it seem like everything's a big deal, and then it just calms down. And then naturally over time, it just keeps calming down. And that's exactly what we're, in a sense, experiencing now. After all the craziness that happened last year, the VIX is still below, you know, even most of last year's lows, currently speaking. Now, people use this as a measure to think that another crash or pullback is going to happen in the market because the VIX is so low. So whenever the VIX is low, it's generally a good idea to look into hedging principles and things like that. All right, so we have this analysis. Let's just jump. So to save time, I have some tabs already pre-opened here. So now we're looking at just 2021. So this was 2022. We can see 66% of the time. Now we have 61% of the time red. This now is 2020. So the big, crazy pandemic crash with the V-shaped recovery, 63% of the time, we can still see the red VIX days really came on Fridays. which is to be expected. And Mondays, usually there's a lot of implied volatility crushes that happens on Mondays as well as Fridays. And then we have, however, on Fridays, if it does close green, I think from memory, it ends up being really green. Let's see if I type in here just Fridays and we pull that down in isolation and we take a look at the net changes, we can see that the days in which it has closed green were pretty big. However, the red days for the VIX were big volatility crushes, and that's what caused a lot of rallies on Fridays in the SPX. And that's, if you've ever traded 0DT options on the SPX and you catch one of these Fridays, those are the days in which you get 1,000 to 3,000 returns on 0DT options. Moving right along, we have, this is now before the pandemic, so 2019, a little bit more of a quote unquote, normal market, 62% of the time. And then we have, this is since 2007. So we have the financial crash in here, as well as the pandemic. We have last year, everything in there we still see is, we'll just round this up to 60% of the time. Some of these days in which it had a net change of 0. So boom, 6 out of 10 times on the daily time frame, the VIX is going to close red. I think that's pretty fascinating, pretty interesting, something to know. So let's just reset this for a second here. And then let's just switch it over to the weekly and then generate this. And then we'll stop with the VIX analysis. And now we have, look how much red that is. So almost 8 out of 10 weekly candles over the past year. And again, this is in covering most of 2022, which was a very volatile year. Let's take the start because the market did pull back pretty aggressively at the start of the year. So just to be in all fairness to the VIX, now we're including that January and February. These are the weekly candles, and look at that. Almost 8 out of 10 weeks for the VIX during the bear market season that we've been in has been crushed. Volatility crush, one after the next. And let's just take a look at the SPY, and this is the SPY since 2007. So this right here is the financial crash of 2008. If I hover over these, so we can see that November and March, these are some of the biggest returns the SPX has had, at least of the modern lifetime of the S&P 500, within the past 20 years or so. And then we have this right here would be the crash of 2020 on this chart. So that's what these are covering. So if I hover over this, we can see 2020, and these are some of the older dates here. So we can get a lot of information just by glancing at this, and we can see that the SPY closes green more times than it closes red. And we can see right here as we take a look at this, that Tuesdays, at least, if we take a look at each year in isolation, I know Tuesdays used to be pretty bad days for the SPY because that's usually when a lot of financial news would, that's when a lot of macro news would come out. I think the Feds usually used to talk on Tuesdays, and certain reports and stuff used to affect those days there. So that's why we have these the red spike there, and again, that's just from memory. And so I wanted to point that out because if you know this, and this is just data here, and we can take a look at this and we can see on the chart this information. If we take a look at options, we can see around key events, there are days in which the implied volatility is higher. So next week, this is the 14th right here. This would be the day that the CPI report comes out, and we can see that's why this implied volatility is higher. So the 14th, we have this spike right here. I forget when the next FOMC report is out, but if I had to guess, I would say it's one of these days here because we can see the implied volatility is pretty high. Also, so whenever you see pretty high implied volatility in a short, less than 30 DTE time frame, it's probably because there's some sort of macro event scheduled to take place around that time. Now, people that know this, that are more experienced, more seasoned, or just different personality, we would say, because you can be trading options for 10, 20 years and still choose to trade, long call options. So let's just jump straight into that. So this is a long put option. And this is just meaning you just bought a put option. You think the SPX is going to go down, you want to buy a put option 44 DTE. When you buy an option, you are what's called long Vega. That means you benefit from an increase in implied volatility. However, we just took a look at the VIX. We know on a weekly time frame, which tab did I have that open here? Daily. Did I close the weekly? Okay, it was the first one we started. All right, so 8 out of 10 times on a weekly time frame, at least this is relative, this can change over time, obviously, but at least during a bear market, we have 8 out of 10 weeks, the VIX has closed red. I'll repeat that again. Rounding this up, 8 out of 10 times in the past, how many weeks has this been? 60 weeks, 61 weeks. The VIX has closed red on a weekly time frame. If you buy a put option and you struggle, or you buy a call option, let's just say you're just in a long call and you are long Vega, meaning you generally want a big move, you up or down, you want implied volatility increase. Obviously, if you're buying a call, you want the market to go up and you want it to go up big, because if you buy that call option, and let's pull this down here, this is your P&L curve. This is a risk profile. This is Option Strat. I think this is an amazing site to use whenever you're analyzing your positions, your options positions, if you're not familiar with Thinkorswim's risk profile. All right, so as I increase this implied volatility, just jack this all the way up, this would never really happen like this. You can see there's so much more money to be made just because your implied volatility has gone up. Versus if implied volatility shrinks, you're down a lot of money. That's because you're long Vega. That means you are long implied volatility, meaning you want implied volatility to go up. However, we have the data. We know implied volatility is more likely to go down. If we jump to another long Vega type of strategy, it is a calendar spread. Calendar spread is also long Vega, but this is an oversimplification for how this works, because you can actually use the calendar spread when you think implied volatility is going to decrease. That's whenever you're taking advantage of something called the volatility skew. So let's just say you were to short, you see this implied volatility is 26%, whereas this implied volatility is 19%. It means this is pretty jacked up, more than the average. So let's just say we were to come down here and the normal implied volatility, let's just say, is 18.14%. For the SPX over the past 52 weeks or something like that. I don't remember how this is calculated down here on SPX on TOS. But as we come back up here, we can say that this day is really, it's way above what it normally is. So you're going to use this as your front month. You're going to short that expiration, and you're going to buy a longer DTE option that has less implied volatility, thus taking advantage of a potential IV drop in the front month. If you don't know what I just said, don't worry about it. I'm just showing you guys a different type of spreads that you can take advantage of implied volatility, even if it is a long Vega trade. That means if we were to do the same thing, let's just shrink the this curve here. And this, just for those of you that are new to this is just showing the P&L, or the theoretical P&L at expiration. And as I pull this down, this is showing the This is showing the theoretical P&L at a given date. It's also referred to as the T plus, let's put that in caps, T plus 0 line. And that's what we're looking at right here. If I were to increase implied volatility, you see how it mushrooms, it just blossoms beautifully, and you have a larger P&L curve. If we, or larger profitability zone, same deal. Let's just zoom this out a little bit and jack this all the way up to 100. You can see so much more money can be made. Again, theoretical. It's not really going to work out that way. And then we just brought this back down. Versus if implied volatility was to decrease, you'd pretty much lose all of your money. That's because we're long Vega here, and we don't want that to happen with a calendar. The spreads now that are known as short Vega trades, I'm just showing a couple examples here. This is what's called an iron butterfly. And this type of spread is constructed by selling two at-the-money options, a call and a put, and then buying an out-the-money put and buying an out-the-money call. You can say that these are your hedges, these are your protections, whatever, X, Y, Z. Not explaining every single spread here. I'm just trying to introduce and show you guys a different concept of trading options where you're short Vega and how to do that. You would look up, you would want to research what an iron butterfly is. This case now, if we were to pull this down here, we can see if we were to decrease the implied volatility, this trade is actually benefiting. It's actually going to profit from a drop in implied volatility. However, if implied volatility increases, it's going to be losing some of its profit potential. But however, by expiration with a spread like this, it doesn't really matter if implied volatility goes through the roof, because at expiration, this will be the realized gains if the price of the market was to close right at your strike price. Doesn't really matter what happens with implied volatility. The implied volatility is just as you're actually holding the trade, what your T plus 0 line is going to look like. And now the king or the queen, the leader, known as we'll call it the daddy of all income-based strategies. These are consistent. These are known to be quote unquote consistent, or you're looking for income, you want to be non-directional, you want to pick which direction the market's going, is the iron condor. And the iron condor is also a short Vega trade. That means it benefits from a decrease in implied volatility. So if we were to jump ahead and say in the next 14 days, if the SPX was to stay within a certain vicinity, if implied volatility was to decrease, we can see how much profit this spread can make, versus if we reset this and we say that implied volatility was to increase, we can see that this spread would be hurting really, really badly. Right, so let's just reset that. And the same thing at expiration, it doesn't really matter. This will be your profit as long as it stays within these strikes here that you set. And that is the introduction, or something that I really wanted to introduce, the concept of being short Vega versus being long Vega. Most retail traders, when you first start trading options, you just learn to buy a call option or buy a put option. And what you have is not only a delta risk, meaning if you choose a call and the market goes against you, which means the market goes back, you're going to lose some sort of money. You also have theta risk, which means you have risk of time decay, and then you also have a little bit of Vega risk, because if the implied volatility comes down, we took a look at that already, it means you will be losing money just because of implied volatility. And what did we learn from this video? Implied volatility statistically is more likely to decrease versus increase. So the intent was to expose you to this if you didn't already know this. And if you're new in your options trading journey, please research as much as you can about implied volatility and also trading spreads. The iron butterfly is a favorite amongst a lot of traders. You can trade them 0 DTE, you can trade them 3 DTE, you can go all the way out 44 DTEs. I'll show you guys some spreads if I get around to it over the weekend for a current position in which I had running. I've been holding it for about 15 days or so. I already took some profits and it's just been going really well. It's an iron butterfly that I had to open around the 4,000 level. It was a 51 DTE when I had initially opened it, and it's hitting around 18-19% return on margin used. And that's the way I like to trade these types of positions, because they have such a wide room for profit, and you're generally only in them for about 2 to 3 weeks. If you're trading 51 DTE, if you're trading something that's like an 11 DTE, you might only be in it for 5 days, or you can just trade a 0 DTE. There are some guys that run this as soon as the market opens. I might do that one day out of the week or so. So say for example, the market opens tomorrow and we just want to run an at the money spread because we think the market is not going to move. That would have been a perfect trade for something like today. If we zoom in right here, and we see the market essentially formed almost a doji right here. This is just choppy, disgusting price action. This happens to be great for people that trade these types of trades, because if we take a look at this, we can see that the market would have opened here today around this price. This type of spread would have been going for around here. So around 29 bucks, and now it's going for 26 bucks. So that's something to wrap your head around. You're actually selling something and then you're buying it back cheaper. That concept is something that keeps people away from trading these types of things, because it's a credit, and then that kind of makes you nervous. You don't understand what a credit is, but please take the time to really understand this and learn, because you're putting the statistics at your back, and you're capitalizing off of something that actually tilts odds in your favor a little bit more. Now, this is not easy to learn when you first start. It's not, I don't want to paint this picture or perception that these are set it and forget it type of trades. You still need to monitor them. You still need to be aware of what you're doing, because yes, implied volatility does revert to the mean. Yes, 7 out of 10 times it's going to close red on the week. All these types of statistics are in favor of you, but it doesn't mean it's going to be easy doing them. Okay guys, thanks for watching. If you enjoyed this video, like it, leave a comment down below. If you're interested in quant trading app, the links will be in the description. This is an example of the iron fly in which I was talking about a little bit earlier. This was it as it was opened here. It was 51 DTE when I first opened it. And then we can see that now the SPX has been just chopping around the 4,000 level, even though things have been pretty volatile. Yesterday it was up when I'm recording this video, I believe, yeah, I'm recording this video on a Wednesday here. So yesterday when I shared this, it was already up a 4% return on credits, which was roughly about a 19 to 20% return on how much capital I was using for the trade. And it was 51 DT, so pretty harmless. Still had a couple left. So this is about $680 return using just 2 of these. At the time I took profit on 1 more. as I mentioned earlier in this video. And the link to the Quant Trading App Discord is in the description down below. There is a public section. I'm not active in there. There is a gold membership, and then that gives you access to all of the data in which you see that I was sharing a little bit earlier, as well as a ton of other features. Thanks for watching, guys. Catch you in the next one.